It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Hey, welcome back. Thank you, me, and thank you all for listening to this program, this wonderful podcast, Managing Your Financial Future. So happy to be back. Professor Plum, hello.
Good morning, good afternoon, good evening, depending upon what time you're listening.
Good morning, good afternoon, good night. Doesn't really matter. People are listening in all time zones. Had a note from somebody not too long ago who said they were listening to us in England. And I thought, well, why would they want to know about,
Well, they may be visiting.
Well, that's what it was. They said, I was listening to your program. I'm in England right now. And I said, oh, but you're an American who's listening in England. Thought if this program's going international and they want to know what retirement rules are like,
we're going to have to study up on some other rules besides the ones we know already.
Exactly.
We're pretty good. I mean, we've got the U.S. rules down pretty pat, but outside the U.S., I don't have the rules very well.
I don't have the National Institute of Health or whatever it is in Britain. I don't have their rules quite specifically, their national health system. But hey, you know what? With the international appeal of this program, maybe we should do that. So why don't you start studying on all that?
I'll start with the Canadian pigeon. I know a little bit about that. They're closer. Yeah.
Oh, man. Well, anyway, it's nice to be back here. I was looking at the calendar.
It's flipping through quickly, isn't it?
It's really flipping through quickly. It's going very flipping quickly. And we're on the second to last episode of Season 7. Now, I checked, and I think it was last week, I checked on how these are going to work. Our 12th episode, these go in 12-episode chunks. So our 12th episode ends, I think, around live anyway, around early December, early to mid. So we're not going to be around for the rest of the year to finish to do Season 8. We're going to be doing Season 8 starting in 2022. Now, some people are listening to this in 2022, and I get that, and it probably doesn't affect you. But for those of you who listen to this download on Spotify and you're used to hearing every week a new show, we'll be off for a couple of weeks here at the end of December and then back live. So just some housekeeping notes there. Are you ready for Christmas, by the way?
Sure.
Okay. All right.
I mean, I don't have that many gifts. It's not like I'm going out and buying lots of little gifts like we used to do when the kids were little. Now it's like one thing per person. And yeah, I'm caught up.
Yeah, would you convince my wife that one thing per person is...
Well, I didn't say it was any cheaper doing it this way.
But it's
just
easier.
It's easier.
It's easier.
Definitely
That's
easier.
That's the problem.
One thing, but the price tag is a
that's
little
never
bigger.
Going to change. Well, what I've noticed this year, and maybe others have too, is with this supply stuff happening, it's very tough to get certain items, specific items of clothing, in fact, in the correct size, trying to order stuff. So,
I noticed our online stuff blowing up in October-ish.
Yeah.
As my wife started doing Christmas shopping, figuring we better get it while we can.
That's the thing. And, so who knows where that's going to go. But anyway, time is creeping along, and time can get away from people, quite frankly. It's easy to do. I had to think the other day, what year is this? This is 2021. So we're going to be 2 years into this whole quote-unquote pandemic thing, more or less, and lives still have not gotten back to normal. But time does get away from people, and that can be a problem from a financial standpoint for any number of reasons.
Well, time can be a great ally, or it can be a complete adversary. I mean, it can really mess with you. If you have a lot of time, it can really help you with your savings, your ongoing. You don't need to save as much per week, per month if you've got 20, 30, 40, 50 years. But it can also be a very bad thing if you've procrastinated and now you don't have the time to save because you have to save a lot more. You don't have compounding working for you. But there's also just things that get away from us. I mean, filing our taxes sometimes is like, but we get reminded pretty heavily about April 15th. Make sure you file your tax. We hear about that. But there's other deadlines that we forget about and
Yeah.
nobody's reminding.
Well, I think because we're so conditioned to the old April 15th tax deadline that a lot of people, when the Christmas holidays are over and you're back into January and it's a new year, you start to think about, well, I'm going to have to get my taxes in order. I do think that because whether you're 22 or 82, your taxes are due at the same time for the most part. You got to have them there by, or something there by April 15th. So, but as you get older, and as time starts to slip away, there are certain things that you have to remember to do. Get your Medicare stuff out of the way when you're age 65. Apply for that.
Your initial enrollment.
Your
yes.
initial enrollment, get that done. You don't want to forget that.
Assuming you're not covered by group coverage at work.
Right, exactly. But if you're retired, that's the kind of thing that can get away from you. The bigger one seems to be required minimum distributions, and that's what we're talking about here, RMDs. There are people who don't know that there's a required minimum distribution.
We talk about required minimum distributions quite a lot, and I've heard it in different areas. It still baffles me that people don't know that they have a required minimum distribution from a tax-deferred retirement account.
Well, if you're not paying attention or you don't know, you've never had one, you're almost, as you approach your early 70s, you've never really thought about it. Now, for some people, they don't know there is one because they've been living off more than the required minimum distribution, and they've just been taking the money out to live on.
Or they know that they have a required minimum, and they're worried about it, and they're happily surprised when they find out that the money you're taking out to live every month
more than
is enough to satisfy your RMD. So that helps. But there are those that believe that the RMD is in addition to what they're already taking out. And some people believe that the required minimum distribution is very large. Wow, I've got $100,000. My RMD is going to be like $20,000-$30,000.
Wow,
not unless you're about 100.
That would run it out fairly quickly. So what can happen is you can reach age 72. It used to be age 70 and a half.
Right. The Secure Act pushed it out to the year that you turned 72, not the day.
Yeah.
And even back when it was 70 and a half, it wasn't the day you turned 70 and a half, it was the year. So the required minimum distribution is for the tax year that you reach a specific age or are older than that specific age. Mm-hmm. So if you reach the first required minimum distribution now is at age 72 for the owner of an IRA, 401k, 403b. If your birthday is, December 26th, you don't have to wait until December 27th to take your required minimum distribution. Any distribution during that tax year qualifies as a required minimum distribution. Heck, you may only be, 69 in a week because your birthday was, the week before the end of the year. You're nowhere, or 71.
I called 71, yes.
I keep going back to 70 and a half, but now you're nowhere near 72 yet, at least in your mind. I'm only 71. I just barely turned 71.
I just turned 71, yeah.
It's for the tax year, which for most people is the calendar year, that they reach that age, 72.
So is it true that any distribution you take out, the first distributions will satisfy, they go toward that required minimum distribution? Is that how that works?
If the money stays out, yeah.
Let's say it stays out.
So, I take out, $5,000 for whatever reason. I don't even know about the RMD yet. Sure. Did you distribute enough money? Mm-hmm. It's not a matter of, did you distribute this and call it a required?
Yeah.
You can call it whatever you want. Did the money come out of the IRA? Or we'll use IRA.
And did you pay taxes on it?
Well,
put it on your tax return.
You're gonna get a 1099.
Yeah.
And so it's going to go on your tax return.
So the penalty for not doing so can be very, very stiff. It is very stiff. Now, you do have one exception on your first required minimum distribution, Professor.
Right.
Plum.
I guess they feel bad for people that it catches up to them and they don't. Once you've had a required minimum distribution, you should start remembering it from year to year to year. But that very first one sometimes will creep up and, wow, I didn't even realize I was that old to take a required minimum distribution, and I forgot. And now I'm filing my taxes, and I realize I'm in trouble. I've got this huge 50% penalty of the shortfall. So if I had a $10,000 required minimum distribution and I did not take it, that's potentially a $5,000 penalty.
Yeah.
And I still have to take the money out at some point and pay taxes on it. So the very, very first required minimum distribution that you have, normally only distributions during the tax year count. So normally it has to happen between January 1st and December 31st. But with the very, very, very first required minimum distribution, I have until April 1st of the following year to satisfy it. Now, if I turn 72 in 2021, I have a required minimum distribution for 2021. I can postpone. This is my very first one. This is the only one we can deal with it like this. If I don't want to take it this year or I forget, I have the first 3 months of 2022 to take my 2021 required minimum distribution.
Mm-hmm.
But I still have a 2022 required minimum distribution as well.
So, you're
so
gonna
I end
have
up
two.
taking two. Now, I have seen people use this to their advantage. They're working through the year that they turn required.
They're in a big tax
They're
bracket.
making 100, 200, 300, whatever the number is. Yeah. And so they don't want to take it this year, and they're going to retire at the end of the year, and then they'll double up on their RMDs for next year because that's nowhere near how much they're making now, and they'll be in a lower bracket. That makes sense. Or you just plain forgot.
It doesn't matter why.
And then you wait,
and
you have, but you don't have until April 15th.
You have April 1st.
April 1st.
Yeah.
So I don't know why they didn't make those dates coincide, but
I don't know.
They didn't,
but,
so we got to live with it.
Well, they give you 1 quarter. You have an extra quarter.
Now, that's for people, that's their very first one. Now, well, their very first required minimum distribution is the year they turn 72. But if you're still working and you are not the owner of the company, in fact, you're not even a part owner of the company, as long as you don't own 5% or more of the company that you're working for, that company's plan does not have an RMD until you terminate. Now, if you have other plans, you have a 401k from a previous employer, you have IRAs, those still have required minimum distributions. But your current employer's plan that you are not an owner of does not have a required minimum distribution until such time as you retire.
So if you stop or until you stop working for that.
Until you terminate employment from that. And then that's your first RMD from that plan.
So now you have
until April 1st of the following year to take
retirement.
the RMD for that plan if you want.
But you still have one.
You still have one.
Yeah. So there's a mulligan there for your first one, and that's okay. That's probably a good strategy to do in some cases. Yeah. If you have a large income, maybe it is, maybe it isn't. You need to check with your advisor. All right. So what if you're over 72 and you have none of that? You're 74 or something, and you just didn't know. Or you were taking money out of you took it for a few years because you needed your money to live, and now you're age 76, but you don't need that much. So you wind up taking less than the required.
And the percentage does go up a little bit every year. Yeah. Now, I talked about earlier, people thought the required minimum distributions were pretty high. The reality is when they first start, when you're 72, they're not outrageously high. It's about 4%
of the balance.
And that 4% of the end of last year's balance. Yeah. So each year they look at the end of the previous year, and you use that number and divide it by a life expectancy factor that the IRS has given us. Bless their hearts. They know how long everybody's going to live. It's a uniform table, and that creates your required minimum distribution for this year. Each year that you live, your life expectancy goes down a little bit. So the older you get, the smaller the number is that they're dividing by, which means the larger the percentages of your balance that you're going to take out. Now, it's about 4% when you start at 72. It's about 5%-ish at age 80, and then it goes up from there. And if you make it all the way to 115, it's about 50%.
Well, but you can never technically run out.
Yeah,
I mean,
yeah, because at 115 they say it's basically 50% every year going forward.
Right. So so when you wind up with 12 cents left in your IRA,
you got to take 6 out.
You got to take 6 out. So
then 3.
At some point,
and hopefully it earns a little through the year. But
well, it'd be nice. But if you had a penny left, I don't know how you divide. You probably have to liquidate
at
that
some
cent.
point. Yeah.
We're getting ridiculous, but that's true. That's exactly how that works.
It's not difficult, but you just have to remember to do it. Now, what we've seen this year are people forgetting that they have the RMDs because for 2020. All RMDs, all required minimum distributions were waived. So some people either reduced or eliminated taking like a monthly distribution. Some people just set up a monthly, say, okay, my RMD is $4,800, give me $400 a month, or something. And some people say, well, I don't need it anymore. They're going to waive it this year, cancel my automatic draft, and then they forgot to restart it for 2021.
Could very well be. That's a good scenario.
And so people are coming back to the idea of, oh yeah, I have it's 2021 is gone, and it's 2021 right now. And we got an RMD again this year. They haven't waived them for this year. They're back and they're coming on strong.
So you forget. Let's say you just forgot. The year's come and gone. You're not 72. You're somewhat older, and you just forgot. Well,
there's different reasons for forgetting too. I've had. I was talking with an advisor just last week. They have a client who had a stroke and is basically incapacitated right now, but they did not have a power of attorney or a trust in place. And so they can't figure out how to get the money out of the IRA. And so they said, well, what are we going to do? What do we have to do? I said, first off, you need to try to get a conservatorship put on. And it did take about a week, but they got a conservatorship. But if they couldn't have gotten it done that quick, the IRA custodian is not going to just take somebody's, granddaughter's word and say they need to have this money distributed. Even if you have everything set up where it automatically goes to the person's bank account, if they're saying, well, we need another $5,000 to satisfy the RMD or whatever number, they need the owner to tell them that. They can't just do it. They can't just create the RMD. And so what happens if you can't get it done? I mean, this person, they expected to take their RMD the last 3 months of the year. Another reason why I like to take them at the beginning of the year.
That's a whole other topic, but yes.
And unfortunately, they are no longer in control of their faculties to be able to do this. They're still alive, and they need somebody else to do it for them. And so we have to have things in place, power of attorneys. Sometimes it takes time, or sometimes we don't even think about it until the year has passed. Now what? What if the person that's helping, I think it actually in this case was a granddaughter that's helping out the owner of the IRA. What if the granddaughter didn't know about the RMDs? And she didn't know grandma did or didn't take the RMD, and she gets into next year or even a couple of years down the line and finds out,
nobody took the RMD.
I didn't even know grandma had an IRA.
Well, so what can you do? Let's talk about what you can do. I mean, if you're able to take, I would think if you're able, you just forgot, you're not laid up in a hospital or whatever, you should probably take the RMD.
Well, definitely once you realize you've missed it, take it. Just go back, calculate it, 5,000, whatever the number was, take it out and make a note of it, and then when you file, and then make it do the RMD for this year too. Going forward. And then when you file your tax return, just write a note, with the form.
There's form
5329.
5329, right.
Which is the form that either excludes or adds penalties to distributions from retirement plans.
It's called Additional Taxes on Qualified Plans and Other Tax-Favored Accounts.
Okay.
That's the actual name. I looked it up.
I liked my term better, but
I did too, yeah.
And that's where if you get a 1099 when you're young, but you rolled it over and you don't owe the penalty, you file 5329 to get out of the penalty.
Yeah, okay.
And other ones where you do owe the penalty, you file 5329 to say, yeah, Mr. IRS, I understand, blah, blah, blah. Here's my penalty money. But in this case, you're going to try to, basically plead, your case to the IRS courts and say, please, don't penalize me. We had the best of intentions. It just got away from us.
I had relatives from out of town.
I had a flat tire.
Yeah. Whatever you can do, and then just say it wasn't my fault.
It will never happen again. I'm sorry. Yeah. And when we've seen this happen, I have yet to see the IRS come back and say, nope, we're not going to accept your apology. We're going to hit you with a penalty. I'm not saying that you won't be the first, but I have not seen the IRS be that horrible that they're going to do that.
I think it depends maybe on your tax filing history. I think it depends on how many times this has happened to you.
Yeah, but if you write a letter every 4 years because you've missed it for 4 years, then take it. Miss it for 4 years, then take it. Okay, the second time, third time, they're probably going to say, no, this is no longer an accident.
Yes, you're taking advantage of this.
But
now, when you
send them a letter and say, I'm sorry. Here's the reasons. If you have reasons, I have rectified the situation. I have taken the money, and I took X amount. My RMD for 2019 was X. I have now taken that on such and such a date. My RMD for 2021 was Y. I've taken that. I'm on the straight and narrow path. Don't hit me with that 50% penalty.
Well, okay, so when you file this 5329 with your letter of explanation, is it a good idea to pay the penalty, especially if the IRS has notified you somehow, or do you not pay it?
Well, if the IRS has notified you that you've got the penalty, now you're dealing with a different situation. Now you're dealing directly off of the audit form, and you're asking for forgiveness.
Yeah.
And so you haven't paid the penalty. You're trying not to pay the penalty. And so you're not dealing necessarily with the 5329 the same way as somebody who just forgot and is coming to the IRS ahead of being caught.
Ah, okay. So you're stepping forward.
You're coming and saying, Mr. IRS, Mrs. IRS, or person IRS, I guess is how we do it now.
Yeah.
I missed it. Here's why. I just forgot about it, whatever. I've rectified it. I'm not, at this point, I'm not paying the penalty.
So you're hopeful that they'll write back and say everything's okay. Now, for some reason, they say, I'm sorry, you owe the penalty plus interest on the penalty because we didn't get back to you for a year or whatever.
Well, that's what I was saying. I have not heard them doing so far.
You never
know. But you never know. And like I said, you may be the first one that gets caught like that. And if you're Murphy's Law, like I am, you will be the first one that gets caught. So try not to miss them. That's the bottom line. But
I would think that it would be easy for you to. To me, the IRS is going to. If you don't take that penalty, or if you don't take that RMD, the IRS is going to. I would think trigger it. Or something would trigger.
Well, it should. I mean, the computer should catch it. It doesn't mean they are, but the computer should catch it. It shouldn't be too hard. I mean, I think Big Brother knows how old you are, and every year they get the 5498, which is an informational tax return filed by the IRA custodian every year.
Yeah. That
tells them how much was either contributed or what the year-end balance was. So their computer should be savvy enough to say, flag every 72-plus-year-old individual or every beneficiary of an IRA.
Yeah.
And make sure that there is something on the IRA distribution line. If there's nothing on the IRA distribution line, the computer should pick that up quickly. I don't know if that's a fact. I don't know if they've really got it programmed that well, but it shouldn't be that hard to catch.
I had read of somebody somewhere who hadn't taken one for a couple of years, and I've never heard anything. Maybe it takes a few years for the IRS computers to catch up, but to me, that's like not filing a tax return, and I don't know, or
you would
not
think
paying your
it
taxes.
Depends on what they're programming and how they're going about doing it. I haven't heard of very many people being caught. I have heard of a few.
But
usually
you don't want to get caught. You don't.
I don't want to tempt them like that.
No.
I don't want the. Even when you know you've done everything right, if you get a letter from the Treasury, it just makes your heart skip a beat, and it's like, oh God, what did I forget? What did I screw up?
What did I do? I messed something up.
Oh gosh.
Yeah.
And you get a letter from the IRS, and it even when you're right. And I got one years back from an HSA issue,
health savings account,
and I was correct, and I sent it back with all the documentation. I was just cleaning out some files on my desk, and I had every charge on the HSA. Boom, boom, boom. I had lots of documentation, and I've never heard from them again. But it was like, oh man, when I got that letter,
well, even just when they question you, even as they pull you aside for questioning, pretty much, like we have a letter, we have some questions on your tax return that we need answered.
I've never had that happen.
I did the year that I was on a game show.
Oh, way back. Well, yeah, because things are totally different.
They wanted to know why I claimed less than what the game show told me I won.
Yeah.
They weren't assessing anything.
They just wanted an explanation.
They asked why.
Yeah.
Which I sort of expected anyway. I didn't send a letter of explanation until they asked for one.
You won big.
I won pretty big for the time.
1980?
1986.
86.
23,000.
And back in 1986, that meant something.
Well, it meant something to me because my total salary, I was in my senior year of college at that time, my total salary was about $4,000. So
almost five.
It was about six
times your annual salary.
6 times my annual salary. Oh, and by the way, the taxes they wanted on that was about half of my annual salary, which I didn't have. So I had to get a loan. Anyway, that was a whole thing. But yeah, it is a scary thing. And so the idea is, of course, to
try to avoid it if you can. But if you've forgotten, don't panic. Rectify the situation and move forward.
Now, you said earlier, we've done. I know we've done some videos on this, but maybe just to cover again why you believe it's good to take the required minimum distribution early. Now, one of the reasons we just sort of said, because you get it out of the way and you're not going to forget. But there are certain strategic reasons for taking an RMD earlier in the year as opposed to later.
Right, and so obviously anybody that we're talking about that has the flexibility to say, I'm going to take my RMD at December. I'm not going to take it until December, or I can take it early. That's somebody who doesn't need the money to live.
Yeah.
And so this is extra money. So typically what's happening is they want to leave it in the IRA so it continues in the IRA. No. The RMD is the same number whether you take it in January or you take it in December.
Because it's based on the previous
It's based on the previous year's balance. It's already set in stone.
Yeah.
I like taking it early, so it's done. I don't have to worry about forgetting it. I'm not scrambling December 30th to try to find somebody open to be able to send it to me.
Right.
That I don't risk having an issue where I become incapacitated or I'm otherwise detained somehow or unavailable to be able to take it. But just from a standpoint, let's say it is $10,000. I'm making these numbers up. If I take the $10,000 in January and I invest it the exact same way it would have been in the IRA.
In other words, all you've done is taken it out and paid tax.
I paid the taxes from someplace. Yeah. And so now that money is invested in my personal account. And if it's invested for growth, because, hey, if I don't need the money, it's probably invested for growth, and it grows 10%. Whatever it grows.
Making a number up, no guarantee, but there you go.
That is now a long-term or a capital gain. If I sell it in the first year, it's a short-term capital gain. But I didn't need the money anyway.
No.
So it's I'll turn it into a long-term capital gain, or I'll just leave it for my heirs, and under current law, they don't pay any tax on the gain. But if I leave it in the IRA, that money will grow. If it grows, the same idea, same investment, it would still grow just like it did in my personal account. But now my required minimum distribution for the next year is a little bit larger because I've got more growth in my IRA. And so if the 10 grew to 12, that 12 is, I take out the 10 for the required minimum distribution, but that 2,000 of growth is still in the IRA for next year's RMD.
And it's going to count towards
so
that.
It compounds down the line. And when I do have to take it out, or my heirs do have to take it out, it's ordinary income. On the other side, if I take out that $10,000 and the market goes down.
Yeah.
Okay, so it goes down. I could sell it, and I can use up to $3,000 of the loss to offset other income, or I could use any amount of the loss to offset any capital gains I may have in that year, and in addition to that, $3,000 against other income. If it's in my IRA, okay, so my IRA is a little bit less, but I don't get to use the loss to help me right now.
Now, when you say I could sell it, this is not like a market timing thing where you're trying to sell it at the bottom. This is sort of a strategic
hopefully
sale.
You're not trying to sell it at the bottom anyway. But
well, no, but I mean, if
tax harvesting,
a loss, it's called tax harvesting. There's a difference between saying, well, this thing went down, so I'm just getting rid of it because it went down.
Well, there are stocks where you say, I expect it to go up, but it could go down. If it goes down, if it turns into be a cruddy stock, I'll sell it because it's a cruddy stock. I made a mistake. I bought the wrong thing.
Okay.
Not the first time that's happened. Probably not going to be the last time that's happened.
No.
And so, but if I have assessed the I either need the loss, want the loss, I can always sell it, buy something similar to it.
Or wait 30 days.
Or wait 31 days and buy it back. So to avoid the wash sale rules. But yeah, I could use that loss. So I could change a gain into a capital gain, and I could use the loss if I want to, if it works. Whereas if it's in the IRA, I don't get any of that fun.
Yeah, so you have more flexibility when you have the money personally.
Right. And so that's just taking it early. Now, we've been talking about required minimum distributions, and we've been talking about age 72 and older, but that's only part of the people that have required minimum distributions. If you inherit a retirement plan.
We just talked about that, a week or two ago.
You have required minimum distributions, and you don't even have to be anywhere near age 72.
You could be 32. You could be 22.
12.
Well, 12, I think don't they let you wait?
No, you have to stretch it until you're 18, and then you take it out over the 10-year rule.
Oh, okay. Yeah, assuming they died
simple
20,
simple stuff.
Whatever, yes.
But no, I mean, if you inherit a Roth IRA, you have a required minimum distribution. Even though it's potentially a tax-free distribution, you have a required minimum distribution when you inherit as a non-spouse beneficiary a Roth IRA.
What would be I inherit a Roth, what would have me pay taxes on any of the distribution of that Roth?
Somebody created a Roth in 2019. Maybe they converted $50,000 in 2019.
And it's not 5 years yet?
And it's not 5 years yet.
So the 5-year
2019, we went through 2020. 2019 was a good year. 2020 was a good year. The 50 maybe worth $75,000, $80,000 right now.
Yeah.
And I inherited, and I'm thinking, woohoo! Yeah, $80,000
tax free.
It's not tax free yet because the Roth IRA, the owner of the Roth IRA didn't have any others. So the seasoning period of 5 years hasn't been met yet.
Oh, so even if the owner died and you
We
inherit
still have a
it,
5-year rule.
how old is that Roth? So
People are going to have had them for at least 5 years. And it's really easy to wait the 5 years because, well, in today's world, I don't have any required minimum distribution until the 10th year. So I could just let it season through the rest. But if you're thinking new Corvette, like I would be thinking, I need a little bit more than $80,000.
I want it now, or whatever that is.
You might trip yourself up and make sure that. Or
so
you have
if
to pay
I
tax.
inherit a
no
Roth,
penalty.
If I inherit a Roth, and it only needs it only needs a year or so, but I've never to season.
Yeah.
But I have never owned a Roth. I'm not even in the Roth club. That doesn't matter.
Even if you do own Roths in your name, it's a different world for the beneficiary.
Right, but I'm just saying I don't since normally my Roth, I have to be in the Roth club for at least 5 years to take money out. But if I have no other Roths, never did, and I inherit a Roth IRA,
right? How long did it goes to the ownership? How long has that owner had Roth IRAs?
Right, and he died. So
how long did that owner have the Roth IRA before they died?
So now I wait a year. It's now 5 years.
Yeah, now you got a qualified distribution.
So I'm fine, even though I don't own any Roths myself.
Right.
Okay. I just wanted to make that clear. I assumed from your words that was the case.
Well, and if you did have Roth IRAs, you started in 1998 funding Roth IRAs.
Yeah.
And you inherited this one, like I said, from someone who just started it.
And you say, well, I've been in the Roth club for 23 years.
But this lineage of Roth has not.
Yeah.
Now, I don't know how they catch these. I'm just telling you the rules.
This is funny. Both these topics we're talking about, we're saying we have no idea how they actually catch it, but these are the rules, and if they do catch it, assume that they're going to catch it, and you don't want to have to pay the penalties.
Right, but even beneficiaries, non-spouse beneficiaries, have required minimum distributions. And where we see the missed RMD the most is in the beneficiary world.
Yeah, I was going to suggest that because 30-year-old or whatever, how do they know anything about?
And I had one earlier this year where somebody found out this year, actually they found out in September of this year, that they were the beneficiary of a Roth IRA of somebody who died in 2018.
Yeah.
They didn't even know about it. And it's been, for whatever reason, taking everybody on the estate this long to figure everything out. So they've obviously missed. They missed the 2019 required minimum distribution. Luckily, 2020 was waived, and now they've got the 2021 required minimum distribution.
So you think there'd be a penalty on that?
Where the client has asked for,
okay.
And here's all the. I do not think there will be a penalty on that.
I would not think so at all. No.
Yeah, I don't think so.
Yeah, I would imagine not. Well, the point of all this is, of course, that RMDs. There are some tricky rules to RMDs. The penalty for not getting it right can be very difficult to pay and horrific to pay. It's 50% of the missed amount. But as you're saying, RMDs, required minimum distributions, can affect taxation. And we've talked about this many times. Social Security benefits and all that other stuff. They do kind of leave an imprint on this. So you don't want to get it wrong is the point. And I think it's helpful to have an advisor help you out and remind you or tell you if you didn't know, hey, you've got a required minimum distribution.
Well, the new required minimum distribution rules say you don't have to take anything. If the person died in 2020 or later, you don't have, as a non-spouse beneficiary, you don't have to take anything until the 10th year. And as long as you deplete it completely by the 10th year. But that may not be the best tax advice either, waiting until the 10th year to take it all out in lump sum.
Yeah, you inherit it when you're 50, and then when you're 60, you're in maybe your top,
your earning years.
Peak earning years.
And all of a sudden, and it's had 10 more years to potentially accumulate.
Right.
And so it may have been a lot better to take out at least some amount of money in those earlier years, even though there's no actual requirement that you do so, just to be a tax-efficient, managed portfolio, take control of your own taxes.
Yeah, and it's important to keep that in mind, too, for somebody who inherits, especially a fairly large IRA.
Well, most of the time, the people that are waiting or stretching, when they have the ability to stretch, were all the larger IRAs. If it's a $10,000 IRA, I have never seen anybody stretch a $10,000 IRA
Well,
yet.
no, but if you have, a couple $100,000 or whatever it is,
more.
Somebody who inherits it will think, hey, great, I'm taking it all. This is found money. But
there's
also,
no penalty. That's true.
That's true.
But it's taxable.
But it's taxable, and they're already making 100-something grand a year.
They're piling it on top.
Now they've got 300-something a year for that year.
Yeah.
And whoa.
Or they inherited it from an aunt or a cousin or somebody. They're retired. I'm retired. Oh, I'm not. But
yeah.
And now I put an extra $100,000 on my tax return, and I find out a couple years later that because I took that lump sum, I get to pay more for my Medicare.
Yeah, that's the other thing, too. You don't find out right away until they process the return.
Irma comes in and says, we want your money.
Aunt Irma.
Aunt Irma, she's expensive.
She is expensive, and she'll stay a year or two if she...
Yeah. And it doesn't really matter where the money came from on your tax return that puts you over the limit. Whether it was the sale of a property, capital gain, whether it was an inherited IRA you took out to... These are things that when you have larger chunks of money being thrown on your tax return that could not only affect the bracket, and you pay a little bit higher bracket on some of the money, it could affect you in the future, too, with your IRMA, your Medicare premium.
So before you make a move, talk to an advisor. The folks at Lucia Capital Group, they do this all the time. Professor Plum, I know you deal with this just about every day with various clients of yours, and all the advisors do talk about this. So if you want to get some help with your required minimum distributions, know what the rules are. If you missed one, what can you do? Talk to them here, 800-644-1150, 800-644-1150. We thank them for being a longtime sponsor, Lucia Capital Group. As I said, they do this all the time. They're used to seeing this kind of stuff. 800-644-1150. Go online, read some of the articles, and listen to some of the audio pieces and watch the videos. LuciaCap.com, LuciaCap.com. Professor Plum, thank you so much.
Oh, you're very welcome.
Appreciate it. And we're going to talk next week about 401ks. I know we cover a lot about, RMDs and taxes and all this stuff. But there's a strategy coming up next week that we've alluded to in the past, but somebody emailed us and asked us to expand on it. So we're going to talk about that next week. But that is next week. For Professor Rick Plum, I'm Johnny Dean. Professor Plum, of course, certified financial planner professional. I don't know if I mentioned that at the top.
I don't think we did.
But you are,
I
indeed.
am.
You're a CFP with an R with a circle
I'm
around
certifiable.
it. You really are. For Professor Rick Plum, our certified financial planner professional, Johnny Dean, your podcast host. Thanks so much for listening. We'll talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as a receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.